Welcome to the programme, live from New York City this morning. Good morning to you all. Let's work through the price action together on the S&P 500. About 7 or 8 minutes into the session, advancing by 0.8%. The ECB, rather like the Federal Reserve, attempted to retain what many people are calling maximum optionality. The ECB decided to hike interest rates by 25 basis points. Just on the next month, September, that decision could be a hike, could be a pause. At this point, I don't think there would be more ground to cover, but obviously that could change between this meeting and the next based on what data we get between now and then. One key determination for President Lagarde and the ECB to bring inflation back to target, to break the back of inflation, but ultimately we're not in the domain of providing forward guidance. Everything she said in that news conference sounding very similar to what we heard from Chairman Powell in the news conference yesterday after the Fed hiked rates. That's the equity market story. Let's turn to the bond market briefly and work through what's happening in Europe. In Germany, we see a rally. Yields lower by 8 or 9 basis points at the front end of the curve. Similar move over in Italy as well. And in the FX market at the moment, the euro bit weaker against the dollar. Euro dollar breaking down in and around 110. 110.05 at the moment. We're negative by 0.7%. Here's the ECB chief weighing in on the inflation target.
On the occasion of today, it was a unanimous determination. And the determination is rooted in one very simple direction, 2%. We want to break the back of inflation. 2% is the goal, and we will get there, come what may.
We will get there, come what may. Over at the ECB in Frankfurt, Germany, at the European Central Bank headquarters, Maria Tadeo. Maria, what did you make of that?
Well, Jonathan, in the space of a month, remember, in June, we went from we're not debating a pause, we did not talk about that, to now switching to this is a central bank that keeps an open mind. It is data dependent, but has an open mind. And that means we could, in September, hike or actually go hold. She also said, don't ask me now which way this is going to go, because the burden of the proof, and remember she's a lawyer by training, would be on the data. Remember, there will be new projections in September. So we've switched to we're not contemplating a pause to maybe it's open-minded, keep an eye on the data. And the one definitive conclusion that we got from Christine Lagarde today was the one thing we're not even considering is a cut. So that is the entire 180 that we've seen in the space of a month.
It's not a pause, but it's starting to sound a little more like a pause. Maria Tadeo, thank you. I have to say, following the Fed, focused on the data. Let's get to Mike McKee for the data. Bloomberg's Mike McKee joins us right now. Mike, in the last hour, going into that news conference, the data in America, pretty decent.
Absolutely, John. At least if you're looking forward to a soft landing, Christine Lagarde said the data will tell the ECB what to do. This is already telling the Fed it's going to have to revise its economic projections at the next meeting. GDP comes in at 2.4%. That is up from the first quarter's 2%, and it is much stronger than the 1.8% that had been forecast by economists. It did match the Atlanta Fed's GDP now, so congratulations to the folks down at the Atlanta Fed. Personal consumption a bit weak, 1.6%, down from 4.2% in the first quarter, but business spending way up, 7.7% for non-residential fixed investment. Residential investment not as strong as you'd hope, but if the real estate market comes back, that would help out a lot as well. Durable goods orders 4.7%. Most of that Boeing, a 69% increase in aircraft orders, but basically there's also strength across the board. Businesses are still investing money. And then, of course, every month, John, we watch the jobless claims numbers, and yet again they drop. 221,000, down from 228,000 the week before. And the number of people who are continuing to get benefits, people who are actually receiving a check, 1,690,000, down from 1,749,000, almost 100,000 fewer people on the jobless rolls. We also got advanced trade, which showed a narrowing to $87.8 billion. So overall, good news pretty much across the board for the economy is still growing. People still have jobs. Now the question is, what is the Fed going to do about its projection that the economy would only grow 1% this year, and that unemployment would rise to 4.1%. Both of those numbers in jeopardy.
Yeah, that doesn't look like that's going to happen anytime soon. Mike, just to work through the headlines we got from Chairman Powell yesterday, just on policy being sufficiently restrictive, the FOMC believes monetary policy is restrictive, just not restrictive enough for long enough. Now, Mike, based on the data we've had so far, can you point to the evidence that policy is restrictive enough?
Well, I think we got to wait till tomorrow, John, because we'll see the PCE inflation numbers. When you look at the CPI numbers, they came in significantly lower, as Jay Powell acknowledged. And the Fed wants to see it in their favorite indicator, PCE. We'll get that for June tomorrow. And if we see that kind of progress, then you could argue that maybe it is restrictive enough at this point and just has to be maintained. And, of course, the Fed going to be looking at 2 more CPI reports, another PCE report before their next meeting.
Data pretty decent. An hour and 15 minutes ago. Mike McKee, thank you. The economic data out of America, pretty strong this morning. Upside surprise, the right kind of downside surprise on jobless claims again. Yields higher on the Treasury curve. The 2-year up by 3 basis points to about 4.88 on a 10-year this morning. Yields up by 3 basis points or so. To turn to the equity market, about 13 or 14 minutes into the session, advancing by 0.8% on the S&P. Outperformance on the NASDAQ. Outperformance on Meta, getting it done after the close yesterday with earnings. The stock is higher this morning by 8%. Abby has more. Morning, Abby.
Morning, John. And a very impressive quarter, and more so the outlook. But the quarter that they just reported, they beat both top and bottom line estimates by about 3%. Very impressive is the fact that their revenue growth turned to double digits. Analysts were looking for high single digits, but the growth for revenue grew by 11%. And that's the same deal, even better for the quarter that is right now. Now they are looking for revenue growth of roughly 20% in the third quarter. So that's almost a doubling of what we just had, and they're driven by 34% expansion impressions for the quarter that was, and along with the recovery that they've seen in ad sales. They're really just putting it all together. This was the year of efficiency, so it was going to be cost cutting, but now we're actually seeing this top line growth. The stock right now, John, up 168% on the year, but interestingly, its price to earnings ratio just 21 times, below the mean of the group around 29 times. So when you put that together with that revenue growth, if they deliver, there is an if there, but that is the expectation, you have the stock heading to its best day since late April, up for a third day in a row.
What a rip-roaring rally, Abby. Widely unexpected, massive outperformance so far this year. One of the best performing stocks on the S&P 500 through March of 2023. As things stand, the highest since February of last year, February 2022. That stock up this morning by 7.8%. Let's get to the panel. Academy's Peter Chip, Winnie Caesar of Credit Sites. Winnie, I think we put the ECB to one side. We get straight to the Federal Reserve and the economic data from 8:30 Eastern. Winnie, from your perspective, what signs do you see? What evidence do you see that policy is sufficiently restrictive?
Well, I think that the sufficiently restrictive is very much contingent upon real positive yields. I mean, that's a pretty significant point that Powell made during the press conference yesterday, and also much more encouraging from a policy standpoint. Now, a lot of the other data is definitely not supporting the restrictive, but we can't forget just how brutal last year was. We had an awful lot of transition, a lot of headwinds in different parts of the economy, markets down significantly, volatility up much higher. So given how much transparency there has been in talking about policy, talking about where policy is going to go, it doesn't surprise me that a lot of the moves have already played out. And now we're at this kind of lull of a bit more of a Goldilocks scenario.
Pete, are we in the sweet spot, and how long can it last?
Well, I think we can at least focus on earnings, the economic data. The Fed and even the ECB, I think they're going to take a back seat, right? They have very high hurdles to act. They're going to need to see data consistently high or consistently low to do anything. So I think every big macro data point is going to be less important than it was. That should reduce volatility, let people focus on earnings. And today I think it's really exciting that stocks are up, not because of the dovish Fed yesterday, because Meta really delivered. So I think that's what we have to look for is what's the economy going to look like longer term, and how are earnings coming in?
You published as that news conference was ongoing. You wrote exactly what you've just said. Central banks taking a back seat. You then wrote this. Both are really seriously, honest to goodness, data dependent, referring to the ECB and the Federal Reserve. Pete, how data dependent? And between now and September, what data are they dependent on?
I think that's going to be the neat part, right? Up until recently, they say they're data dependent, but they were looking to either have an excuse to hike or do something. I think they're going to truly analyze this, and they're going to look at 2 months worth of data and see where the preponderance of evidence comes in. As she's a lawyer, but that's what you're going to start seeing is every data point is going to be less important. They're going to look at inflation. They're going to look at jobs. They're going to look at growth. And I think that comes in. I think it's actually going to be steady and maybe slightly declining, which I think is going to turn the Fed at least to the dovish side of things, but not this year. That's a next year story.
So, Winnie, let's put some money to work. How much risk appetite have you got right now?
So we have been actually notching down our risk appetite a bit, and that's not because we are all of a sudden bearish on the outlook, but we think that the compression trade in corporate credit has really played out. We are now tight of our U.S. high yield targets. We're pretty much on top of our U.S. investment grade targets for the end of the year. And these were pretty bullish calls just 6 months ago. So we've come a long way really fast. And we like credit for the carry side of things again. In the European markets, we've been a little bit more cautious overall. Yields are lower there. The potential for a more stagflation-y type environment is definitely something that we've been a bit more concerned about. So we're kind of sitting in neutral almost across the board, waiting to see if the fall vol spike that generally tends to materialize actually comes to fruition this year.
The divergence is pretty interesting, Winnie. I'm pleased you touched on it. Pete, if you look at what's happening in Europe at the moment, growth is bad, inflation's still sticky. In the US, growth's still decent for now at least. Inflation decelerating, disinflation starting to take a hold. Do you see some divergence emerging here, Pete, between not the central banks, who sound the same in the last 24 hours, but their underlying economies?
I think the underlying economies are a little bit different. Europe's behind us. Europe still has to face a little bit more directly the impacts of the war in Ukraine. So I think they're going to be slower to respond. But over time, I think I'm starting again, what's lagging behind? And maybe Europe's the right place to be, right? If they are 6 months behind us in terms of where they are in their inflation fighting, in terms of what they have to do on the rate side of things, that could be an interesting opportunity. And I was agreeing with Winnie. We kind of like credit. And I started to scale back a little bit last week because, okay, we've had such a good run. But I think after the messaging we're getting, I think credit can go tighter. I think equities can go higher. I think it's going to be the laggards. But you really want to start picking, okay, what's run maybe too much? Obviously, Meta's doing phenomenally today, driving the NASDAQ 100. But I like the laggards. I'm kind of leaning back towards banking, commercial real estate, things I've been cutting my position on. I think we're in a nice little sweet spot for the next month or two.
Peter Chair, commercial real estate, really, is what a lot of people will be asking. Why?
Right after Silicon Valley Bank went under, I think 25 banks must have had emergency calls on how bad commercial real estate is. I think commercial real estate is going to struggle. I think it's going to be very regional, but you are starting to see some pressure to go back to the office, right? As more companies start kind of pressuring work from office, that helps a little bit. And these things take a long time to bleed out, even if there's going to be trouble. So I think people got too bearish. You look at how far down most of these indices are or the stocks themselves are. I think there's opportunity for a nice little short squeeze still.
So, Pete, just to be clear, you mentioned a time horizon. We're talking about a 1 month sweet spot. Is that worth the squeeze?
I think it could be in this sort of market in August. Maybe we go 5–10% on some of those indices, maybe more, right? They're so underweight by so many people. It doesn't take much good news to squeeze those higher. And I think people are looking at the Metas and the quote unquote Magnificent Seven, and they want to invest in them. But I think if you're going to plow more money to work at this stage, you're trying to plow it into the things that look like they have the most upside and have been most underweight.
You mentioned Meta up 8% right now. The NASDAQ up by 1.8%. Apple as well, looking pretty decent this morning. Close right here, and it's a record high for Apple. If we close at these levels, the stock year to date higher by 51%. Winnie, we're talking about both the equity market and credit risk here, but just for credit specifically, because that's what you can speak to. What do you think when you hear Peter talking about just the juice worth the squeeze through the next month and being in this sweet spot that you also alluded to?
I think it's a really interesting point. And one of the things that I hear quite frequently from our clients is they went into this year a bit underinvested. Cash balances are still too high. And that, I think, is the most bullish signal that you can kind of find across financial markets. I think this applies to credit. I think this applies to equities. There's been a massive rally across markets, and people still have too much cash. Now the cash drag is not nearly as severe as when, Fed funds is at zero. At least you can get paid a little something for your cash balances. But there definitely is that view that, I've missed out. I just need to hold my nose with this economic data being quite strong, with the Fed being probably near or at the end of its hiking cycle. I just need to get back into this trade.
Winnie, thank you. Winnie Caesar, Peter Chair, Fascinating moment, Transatlantic, the ECB versus the Fed. To the two of you, thank you. Thank you again. Just if you look at things at the last 24 hours or so, the Fed and the ECB sound exactly the same in many ways. But look at the economic data. The backdrop's pretty different. And I just wonder how that evolves in the bond market. Perhaps you get a little bit more divergence, like the divergence we see on the screen this morning, with the German two-year yield lower by 7 basis points and the US two-year yield higher by 4 basis points. Euro dollar backing away. We're down by 0.6% to about 110.12. Let's get some sector price action. Abby, the rally continues.
It really does, John. The risk-on mood is here, and not surprisingly, as a result, most sectors are higher, led by communication services. That, of course, is Meta, up 3.4%. Right behind it, technology and then discretionary. Those are the three mega-cap tech sectors, the best on the year, all up more than 30 to 40%. Today, rallying, making the day more risk-on. Utilities on bottom. John, here I'm taking a risk, but we're seeing something that we have not seen ever, going back to the Dow's entire history since 1900. We are now up 14 days in a row. Just for you, John.
The run continues. I appreciate it, Abby. Thank you. Your trading diary up next. "26 minutes into the session, the data's okay. The Fed's backing away a little bit. Sounds a bit more patient relative to what we heard last year, right? The tech earnings have been decent so far, Meta, Alphabet, and the equity market's doing well. We're up by 0.8%, and many guests are talking to us and saying, maybe we're in a sweet spot through the rest of this summer. We'll see. Let's get to the trading diary for the rest of this week. Intel, Ford after the close, rounding out the week with a BOJ rate decision tomorrow. More tech earnings next week. Qualcomm on Wednesday. Apple, Amazon this time next week. And finally, next Friday, it's payrolls from New York. That does it for me. Thank you for choosing Bloomberg TV. This is Bloomberg.